Thank you all for being here. I've been asked to present my experience. So this is more an individual and a company's experience, which is a little different from what you'll be hearing and you have heard from the other speakers, which is a more macro kind of a picture. So what I'm going to present to you in the next few minutes is what has been my experience as an entrepreneur, as an individual, and as a company coming out of Asia, India to be specific in this case, which has tried to engage with almost all the asset classes that are there, both on the private side and on the capital market side. Just a quick introduction. I'm a partner at an alternative asset manager, which is called DUCC Asset Management, based in London. We manage about 2.7 billion US, 4 partners, invest in all alternative asset classes. Within the firm, I am responsible for our India investments. We've got about 700 million of equity deployed into India and represents about 2 billion of assets that I manage today with a team of 160 people, most of that in India. And there's about 4,000 people working at our sites because the bulk of what I do happens to be real estate or infrastructure oriented, so hence there's a lot of construction activity going on. But that's by way of my introduction. Very common topic today, capital from the east going to the west going to the east, the growth sector areas. So why Asia? I think that macro has been talked about many times before. I won't spend too much time on it. But essentially, that's where the growth is. Today, about 40% of the world sits in Asia. Predictions are about 50% in the next few decades, 50% of the GDP of the world will be moving towards Asia. I've taken essentially India and China out of those two in the balance of my presentation to just show you where the numbers lie. And some of the reasons where Asia is suddenly becoming more interesting is not just because the growth is there, but if you also look at the debt levels, either at the corporate level or particularly at the consumer, which is really the engine for the growth in most of Asia, the middle class with its disposable dollars and with fairly low levels of debt compared to the more Western economies. I think that's what's making Asia today more interesting. Hence, it's probably not surprising that you see that in the GDP growth chart, the first 4 economies that you see over there are all from Asia. Now, India within Asia, which is where I work, has seen the dawning of what is the time for India. GDP has grown about 7 to 10% over the last 10 years. The middle class, which represents about 300 million people, predictions are it goes to about 500 million. The consumer debt level is at about 5% of a GDP, which is at 1.7 trillion. So hence, still very low numbers compared to anything that you've probably seen or heard. That's not including mortgage. If we were to include mortgage, that's another 5 or 6% of the GDP figures. So there's a long way to go. The consumer credit and the mortgage industry both have been growing over the last 5-6 years at about 20 to 25% CAGR per annum. So there's a lot of stuff to be sold into those economies. That middle class, it wants cars, it wants washing machines, it needs homes. So that industry is growing well. So from a perspective of any company, and I represent one small mid-sized company from that area, what do I have to do when I come out here to raise capital in Europe or in the US? I think first thing, mapping is very important. We've looked at all the different providers of primary or secondary capital, whether it be sovereign wealth funds or insurance companies, pension funds, and the professional money managers, as it may be. And we've also had to look at, and there's a reason why we have to work this hard. I'll come to on the asset allocation side just in a couple of minutes. And then you look at across the world, US, Europe, MENA, Asia, Japan. The bulk of the money going into Asia today also is going from the US. Europe has not had that much of its share of Asian investments as the US had. And the US invests from the US, and the US also invests out of a lot of subsidiaries or offices that they have all dotted all over Asia. So the US still remains to be the dominant and large exporter of capital to Asia. But two things particularly, I've been doing this about 7 years. I've been involved in similar businesses before, but at this kind of a level, I've been doing this 7 years. The two things that really spring out when coming out as a businessman from Asia and trying to raise capital in Europe. Matching product with investor is very important. People have different views, people have different needs at different points in time. Just pitching the same thing to everybody doesn't make sense. So the more you can match what an investor, and that is a tough part, and that is something where advisors help. And without advisors, it's very difficult to do this. But matching investors to the product set is important. And the second thing is economic cycles. Countries and regions go through different economic cycles, and there's times when the best product doesn't get funded because it's in the wrong side of the economic cycle. And therefore, what we've noticed is that in fact, I have a slide on this. Sorry. If you look here, this is a slide which shows you, what happened pre-crisis, during the financial crisis, 08, 09, and then 2 years post that and now. Because we have our own sales teams for not just my business, but a lot of the other businesses that we do, we track most of this. When pre-crisis, the interest in Asia was very high. Our conversion ratio of raising capital was very high. During the crisis, it completely fell off a cliff, and nobody was interested in putting money there. Post the crisis, it remained low. But the interesting thing is that now the interest is high, but we're not still converting and raising money because people are still holding on to capital. The interest in Asia is high, all the macro is there, but yet the investments are not moving yet. If you look at it from a public, if you look at the second two lines, the third and fourth line, whereas the public equity and the private, all of them were very high pre the crisis, and obviously during the crisis it fell down. What was an interesting dynamic change is that immediately post the crisis, people wanted to be in Asia, but they all wanted to be in liquid securities, so hence the public markets. Today it's just the opposite, because people who went in post the crisis have not had a great experience or return on public equities. So today the interest level is much higher from the private investment side than from the public side. So hence, going back to the point I was raising earlier, that economic cycles are very important in raising money, particularly when you have a very small number to play for. I mean, Asia gets, I'll come on to it in a moment, not only about 10% of the world's allocation. That's all of Asia, including India and China. The second thing that we had to look at when coming out and raising money here is what format do we raise money in, public or private? And very different rules of the game for each one. Obviously, the public one has a much greater levels of disclosure and reporting and corporate governance, and also it's much costlier to do that. At the same time, time to market, it's 9 to 12 months, and I'm involved in both. In fact, we've got our UKLA clearances through for bringing one of our companies to market on the main board here in London. And there are 4 companies with which we've raised, just $750 million on the private side. Coming to market is a 9 to 12 month process in a place like London, and it's a fairly onerous process. Whereas the private side is about 3 months. Also, the disclosure and the reporting requirements which are there, I don't think that businesses which are less matured and businesses which are small in size can afford to do that. So that's another thing which we found very, very important to consider whether to raise money in a public format or in a private format. In fact, if you go back to 2005, 2006, there was a window of opportunity just pre-crisis. A lot of money was raised from Asia on markets like both the the main board as well as AIM. And, and there's not been a very pleasant experience because a lot of the companies which raised money at that point in time were very early in their sort of maturity curve, and they got hammered by the market because either they couldn't deliver the quarter on quarter kind of results that they projected, or they couldn't deliver the reporting requirements that the market expects, the transparency and the reporting that the market expects in this market. So it's a wonderful market, but it's also a very unforgiving market if the companies are not matured. This is what I've been talking about. So as much as the macro for Asia is good, and it's on every other discussion on The Economist or on CNBC, but Asia still gets very little of the capital from the global markets, and as less as 10%. Out of that 10%, China gets about 3, and India, it's sub 2, it's probably 1.6, 1.7. It's about half of China. So still the total capital which goes into Asia is relatively small. Whenever there's a crisis, capital gets pulled out of Asia. One of the fund managers was talking to me the other day, and he said, but intuitively, if there's a problem of growth in the Western economies, people should be putting more capital. But however, that doesn't happen because the flight to safety, the flight to more secure assets is, even today, the US and the European market. Perhaps not Japan, but Europe and US is still, perception is that's safer, so capital moves. People have a romance with the emerging markets, Asian markets, mainly when times are good. But when times are bad, it gets pulled out. Now, this is changing. In long-term capital allocations, the models are changing. The Asia models are increasing. But this is the situation which is as of now.